Welcome back. In this video, I'm going to be analyzing Enphase Energy. They had their earnings call over a week ago, and they provided fresh financials for the quarter that ended in Q3 2023. And the news wasn't all good. In fact, the stock has really been going down. Is this a good buy? Is this a good dip to buy? Or is it too risky and I should hold off? Well, I'll be answering that question at the end of this video. I'll tell you whether I'm going to buy more shares, just hold the shares that I own in Enphase, or if I'm going to sell my shares in Enphase and move on. My name is Victor. I have an MBA and I like analyzing companies and then sharing that analysis on YouTube. And I hope you find it interesting. Do me a favor and like my video and subscribe to my channel. I'd appreciate that. Also, provide comments on Enphase and the video as well. Now, let me go over my process and go into Enphase Energy and analyze the company to see what I think the company is worth and make a decision whether I should buy, hold, or sell. I have a process I follow when I invest in a stock. I ask 4 questions followed by a decision to buy, hold, or sell. The first question is, do I want to be a part owner in this company? Do I think the industry is a good industry to invest in? Do I believe the management team is doing a good job operating this particular business? Is debt under control and less than 3 times EBITDA? And I want a discount on the stock. That way I could see my investment go up in value. Based on the answers to those questions, I will buy, hold, or sell Enphase stock. Solar energy is something new to most of us. I just got solar installed about a year ago. I'm a satisfied customer. It's really reduced my cost overall of energy. I'm in Southern California. We get plenty of sunshine. And now I've reduced my cost, geez, about $150 a month per month. So that's a pretty good savings throughout the year. Having said that, I think that a lot of people will continue to get solar on their rooftops, principally for economic reasons. I think the cost of energy is really going up. And then other people will do it because that's what they want to make their contribution to help the environment. I think all those reasons are good ones. In my case, I did invest in solar. I've been a very satisfied customer. And I think that the solar industry has a lot of addressable market to go. There are a lot of rooftops across the country. There's a lot of rooftops around the world. And solar energy could be that boost to electric power that the American grid needs, as well as other governments. They need to produce more power. And solar could be that savior for many, many governments. So that's why I think investing in a solar company is a good idea. Enphase develops their own products, which is good. And I think they have very good margins. So I like the industry. I like the company. For the third quarter of 2023, Enphase announced their earnings, and it wasn't pretty. It was a decrease. If you compare the third quarter compared to the third quarter of 2022, it was a 13% decrease in revenue. That's not pretty to see. So that's why the stock's been selling off. The good news is that their profit, if you just compare Q3 of 23 compared to Q3 of 22, it only decreased a little bit. So good job on keeping your profitability. But this big dip in revenue is concerning. Going from last year in the quarter, they had 634 million in revenue, and this year they had $551 million in revenue. That is concerning. I don't like to see revenue drop that quickly. And as I'll get to later, their guidance even shows a worse picture, which is, I believe, another reason why the stock has been selling off. Now, the company is guiding for the fourth quarter, and the bad news is that they're guiding for 300 million to 350 million. That will represent a 51 to 58% decrease if you compare the same quarter of Q4 of 2022. So that's a big drop, and that's a hard one to take, which is why I think the stock has been selling off. Enphase drives a lot of free cash flow. If you look at year to date, their free cash flow is 661 minus 90 million. So they're up at $552 million of free cash flow. That's very good for a company, especially since they've been growing over the last 4 years so much. For them to produce free cash flow is excellent. Although for the most current quarter, if you look at the cash flow generated from operations as well as the decrement of plant, property, and equipment, free cash flow went down 31.8%. So it is a time in their business where they're seeing a contraction, revenues go down, and you're seeing free cash flow go down. So I'm going to take that into account as I value the company. Looking at the numbers and valuing the company based on free cash flows and earnings per share, I think the stock price is currently discounted by 32%. And what that means is each share, I think, based on free cash flows and earnings per share, it's worth about $104, but shares are being sold at $78.92. The first valuation I use is free cash flow valuation. And I'm basically discounting all the free cash flows that are going to be generated by the company into the future. Looking at the first year, I'm annualizing the current run rate, which is a good way to start, the free cash flow flow. And each year after that, I'm going to grow up by 5%. They're a very profitable company. And I think they're going to start growing again because, solar is a very high growth sector. So I'm expecting they're going to start to grow. They're just having a couple bad quarters, but I'm still going to grow at a conservative rate of 5%. And I'm going to grow those cash flows at 5% for the first 4 years, as well as all future years to set up terminal value, which equals all the cash flows beyond year 4. I'm going to use a high weighted average cost of capital of 10%. And when I discount all these free cash flows, I get to a net present value of those cash flows of $14 billion. I'm going to add the cash on the balance sheet and take away the debt to get to an equity value of $14.5 billion. The market cap for the company is $10.7 billion. So using the free cash flow method, there's a discount of 35% available on Enphase. Earnings per share, I'm taking the next 4 quarters that are expected from the company. They are profitable, which is really good to see. And I'm going to go and use a PE of 36. It is a high growth company, although this year they're seeing a drop in revenue. The last 4 years have just been exceptional growth. But I think 36 is a fair PE for a company like this. If they can start to grow again, that could be much higher, but I'll use 36. Based on that and a 5% growth rate, I'm going to discount the earnings per share that I expect in the future and get to a value per share of $97.99. Current share price is $78.92. So discounting the earnings per share that the company is going to drive in the future, you get about a 24% discount. I blend the two, but I put more weight on the free cash flow method to get to a 32% discount on the stock. Looking at where the stock has traded in the past, this stock was trading above $300 per share. And that's really when it's just growing because it was growing its revenue so fast, it was generating free cash. So it really caught a lot of attention. Now it's trading down at $78.92. It's the same company that people are willing to pay over $300 a share about a year and a half ago. But now I think it's come down to reality and it's trading far lower. My value is just above where it's currently trading. So not a big discount, but a discount in itself. It's really come down this year. It's down 68% year to date. So this is I think a good business. They just got to get growing again. And I think they'll see their stock price rise. And that's the big trick is if they can grow, it'll take care of the stock price. So the scorecard for Enphase, it's a terrific business. I really like the solar industry. I want to be a part of it. But this business is not growing, and I cannot give their management team a check mark. So they fail on that second question. They have really negative debt. They have more cash than they do debt. So well below 3 times EBITDA. So their balance sheet's in really good health. And there is a small discount available on Enphase, but based on the risk the company has, not enough of a discount to really be worth investing in. I'm going to hold my shares in Enphase and give them a quarter or two to see if they can start to grow. If they start to grow, this stock's really going to take off. But if they don't grow, I think the stock's basically going to bottom feed and just trade sideways, if not downward. because just won't be a lot of excitement in the stock, and investors will ignore it. So we'll see what happens over the next quarter or two, and hopefully they right the ship, they start growing, and then stock price will take off. So that's my evaluation of Enphase. I think it's a neat company, but they could be the neatest company with terrible financials, and it wouldn't be a good investment. I think that the company has seen, a lack of growth in this most recent quarter, which is really forcing their stock price to go down. But if they can correct it, I think they have a solid business. They have good products. They have a sector that is growing. So I think Enphase can take off if the company grows and they maintain their profitability and they maintain their free cash flows. So that's my evaluation of Enphase. I hope you found it interesting. Please do me a favor and like my video, subscribe to my channel, and please comment on the video. I'd really appreciate that. Good luck investing in 2023.